Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. And a longtime member of the Posse, please welcome newcomer investor. I'm going to throw it over to you to give yourself a brief introduction.
Thank you so much for having me. Like I told you a couple minutes ago, it's really an honor to be here. So I go by newcomer investor. I honestly am just a regular guy, 25 years old, started investing just a few years ago. And we can talk a bit more about my beginnings in a bit. But yeah, honestly, just like I said, regular guy, excited to be part of the community and just tweet about investing and get lots of great ideas from people and share my ideas along with it too. That's really it. Yeah. So
yeah, awesome.
Yeah,
that's awesome. We should point out that you're in Canada as well, so we're going to be talking probably a lot about the Canadian market.
Oh yes,
odds are good. We'll touch on some of the different U.S. companies as well.
Yes.
And
Chinese.
Any favorite sectors you'd like to hop into, whether it's REITs or telecoms or energy?
Yeah, so honestly, my approach, I love companies that encompass a lot of different things. So with that, I have to bring up Brookfield immediately because, like I said, it's my favorite, and I said we talk about it. So Brookfield Asset Management, I think it's a very well-known company, but within the investing community, it's a little polarizing. Some people like it, some people don't, because it's a little complicated because they have so much stuff going on. Although very recently, as of yesterday, they've made things much better with that. But basically, to summarize Brookfield in a couple of words, they do two things. One is they own a whole bunch of real assets, so real estate, utilities, data centers, all kinds of stuff. And they just monetize these assets. So they bring predictable cash flows, they monetize it, they fix them up, then they sell them 5-6 times the value. That's one part of it. And then the other part is asset management for institutions. So they build all these funds with other people's money, and then they invest it into these sectors that they're professionals in. And then they make money through carried interest. So that's the capital gain at the end from the investment, and also a management fee. So it's super profitable model. They just keep scaling, they keep growing, and it's just absolutely, it's been an amazing long-term compounding story. So what they did very recently, which I think is genius, to be honest, is, like I said, a lot of people didn't like Brookfield very much because when you look at their balance sheet, it's really complicated because there's so much stuff going on. And they realized that, and they realized they're probably trading at a discount to their intrinsic value for that reason. So they said, you know what, let's just split the company in two, which will better reflect what we do for those two different parts, because that way people who just like the asset management can just buy that, and people who like just the ownership of the real assets can buy the corporation instead. So as of, again, today, pretty much, there's two companies. There's Brookfield Corporation and Brookfield Asset Management. Brookfield Corporation owns 75% of the asset manager, and then the market owns the remaining 25%. So for me, I plan to hold on to all those shares, but in the future, should I add more, it will probably be the corporation. And with that, actually, oh yeah, no, go ahead, sorry.
So today, when you tweeted that you wanted to talk about Brookfield Asset Management, obviously I looked it up because I'm not overly familiar with it. Obviously, I've heard of them before. And the first thing I noticed, my eyes go right to that dividend yield, and I'm like, wow, that's pretty low yield.
Yes,
any thoughts on the low yield?
So see, here's the thing. So for me with investing, really my philosophy is always, I don't know better than everyone else. Like I'm learning, and that's why I started even this tweeting. It wasn't so that I could tell everyone how knowledgeable I am. It was actually the opposite. It's to keep learning from literally all you guys. Like again, you and John, I listened to the conversations today. You guys are legends. So it's about learning what
Thank
other
you.
people.
Thank you. I think
no, seriously,
Dividend John's a much bigger legend than me.
Yeah, no, but you're a legend also for even just doing this, right? Because it's huge. It's a great platform. So I like to study the greats and kind of learn what people who are older than me have done so that I can replicate or maybe even do better than what they did. We'll see. But if I can replicate Warren Buffett, that's good enough for me, right? So anyway, with that, so with that though, so my instinct and my personality, I love dividends. I like getting, this 4 or 5% yield. It's great because a dividend is like a realized gain every single time, right? It's cash.
Every month or every quarter. They're just
exactly,
handing you money every month or every quarter, right?
exactly. However, when I look at, so like I said at the start, I'm 25 years old and I have to try and keep that in mind. And I look at over the long term, what can give me the biggest like total return? It's
Right.
long-term compounders, probably more than, higher yield type of stocks. So when I look at a company like Brookfield, they had about 17% compound annual growth since in the last 20 years. And they have a plan to pretty much do the same for the next 20 years. When I look at that, given my age, I'm forcing myself to prioritize companies like that and prioritize the S&P 500, which is my biggest ETF right for now. I'm trying to really prioritize these types of companies because I'm looking at that long-term total return. Another thing I'll bring up too of Brookfield is they have a low yield, but they have pretty good dividend growth. So it's always been very high single-digit growth, which it's not a lot, but it's not bad, right? It's better
Right.
than, like, for instance, I love Enbridge and I own Enbridge, but they gave us a 3% raise recently. It's all right, but I'm not going to make millions and millions from 3% raises, but if I can get 10% raise for 20 years, it adds up real quick, you know? And last but not least, of course, with regards to Brookfield's dividends, now that they made the split, the asset manager is going to have a much bigger yield. At least that's what they've reported. Now, I'm waiting to get more information on exactly how much that dividend is going to be. But so far, from what they've said, the corporation is going to retain most of its earnings to reinvest in their assets. But the
Yeah.
asset manager is going to be like a capital light model. They just want to give all the money to shareholders. So for people who are interested in the Brookfield story, but who also want a good dividend, it's probably the asset manager that will be better for that. But for long-term compounded returns, I think the corporation is where it's at. And another thing too that I have to add again about Brookfield and about how great they are, they're really value investors, and I just love how ruthless they are with their deals. To be honest, they will always do what's best for their shareholders. So I actually, because I heard you guys talk about this again with the episode with John. I think you mentioned he owned Brookfield Property Partners, right? Which was one of their REITs. It was a subsidiary of Brookfield. Brookfield
He's
Asset
heavy just
Management.
in his whole portfolio is 6 banks, and Enbridge was one energy, the two of telecoms,
Yeah,
and a
so
couple
he
or one
used
of
to own
the
it. He mentioned he used to own it and then he sold,
used
and
to
I'll
own it
explain
maybe,
why.
yeah.
So this is the thing: is so Brookfield Property Partners, they're great real estate REIT company. It was awesome, but when the pandemic happened, they totally got crushed, right? Like all REITs. And I bought lots of RioCan at that time. We can talk about
Yep.
RioCan too later. Because I know you have RioCan too. But anyway, Brookfield Property Partners was a
Yep.
disaster. And I'm pretty sure they cut the distribution too, and it was just terrible. So what Brookfield Asset Management did, because like I said, these guys are ruthless deal makers. They said, let's just privatize this company at a dirt cheap price. So they bought Brookfield Property Partners. It fell. I don't remember like the exact price that it was at, but it was at, let's say, up here, and then it fell there, and then they put it at like here. So it was a huge deal for the Brookfield Asset Management shareholders. But of course, all the people who held the REIT, who had it just for the income, were really upset because they got purchased at a honestly an unfair price. So Brookfield Asset Management will always do what's best for the shareholders at the top of the pyramid. And that's why, like I said, I will always prioritize the corporation, because if they have a chance to buy their subsidiaries and privatize stuff or whatever, they'll do it. Whatever is best for them, right? So, but I love that, because those are exactly the type of people that I need to manage my money, because I don't know much about real estate, but if I can give my money to people who do the best real estate deals, then that's good enough for me.
Yeah, no, that's a great way of looking at it. I do just want to also mention your age. You mentioned that you're only 25, so you're in a great position to, like you said, in 20 years, when you're into your mid 40s, or even 30 years when you're in your mid 50s, and you're, compounding this over time and just growing your, whether it's monthly or quarterly dividends, and you're obviously really focused on the growth of the company as well.
Yeah, yeah,
Next point, I just want to stick with Brookfield for a minute, because obviously there's several different Brookfield stocks in that Brookfield
yes,
ecosystem, not just Brookfield Asset Management. I believe I looked at about 4 or 5 different ones today. There's like a Brookfield
yeah.
Property, a
They're all over the
Brookfield,
place. Yeah,
yeah. So Any thoughts on any of the other positions? Are you into any of them or on your watch
100%.
list or?
Yeah. So I used to own Brookfield Infrastructure Partners and Brookfield Renewable Partners. At this time, I actually sold infrastructure just because I had a big profit, and I thought, you know what, like I love the company and I own it through BAM, like the top anyway. So I sold it for profit. I still own Brookfield Renewable Partners. Honestly, I like all the subsidiaries too. Like I think
Right.
for people who are interested in kind of going further into these areas or industries, it's great. I think Brookfield Infrastructure especially is gonna just keep growing because you get access to utilities. Like they bought Interpipeline. You probably know Interpipeline, right?
Yeah.
That was a popular Canadian stock. I think Pembina Pipeline also bid to get IPL, but Brookfield Infrastructure got it because, like I said, they're great deal makers. So they have that. They have data centers. They have telecom. They have like even ports. They have all kinds of stuff which are all essential for civilization basically to function, right? So and
Right.
also another great thing is that a lot of their money is inflation protected. I mean, it's kind of like with Enbridge too, and the types of deals they make, right? Is if there's inflation, they have these deals in place to just increase the prices as well. So Brookfield Infrastructure is really good, and I think of the subsidiaries, it's my favorite. Brookfield Renewable Partners, I think, is awesome too because it's not just about providing renewable energy, it's more about transitioning. So what I mean by that is they'll also be involved in energy, the types that aren't necessarily the most green, but it's just from bringing people. So let's say if you have like the dirtiest energy, let's say it's coal is here, and then you have solar, which is there. Brookfield Renewable is as much focused on bringing you from here to here than from here to there. You know what I mean? So they're just professionals
Yep.
in providing these solutions for all kinds of companies. So they're great and they're growing and they're looking towards the future, right? So yeah, I think for people who are interested in these
And
areas, yeah,
I looked at a bunch of the different Brookfield, like you said, subsidiaries, and a few of them do offer the higher yield. So some of them did look a little
yeah,
more
that
attractive in
too.
that
Yeah, I
4%
should have
yield
mentioned
range.
that. Exactly. Yes. Yeah. So I mean, right now I think infrastructure you probably get like a 3.5%, which isn't huge, but it's not bad. And right now renewable is probably around 4% because it
Right.
dipped a lot around the same time Algonquin Power did. We can maybe talk about that one too if you want. I think you probably own it too, right? I do. I was really disappointed in
I
that
do.
Yeah, that hurt. So I mean that hurt a bunch of renewable companies. So Brookfield Renewable around that time they kind of dipped too. So now they have a 4-ish% yield, which is good. So yeah, and then they also have Brookfield Business Partners, and they're more focused on private equity. Which I'll be honest with you, I don't understand private equity as much, and for that reason, I'm not like I really like to buy companies that I can explain to a 5-year-old what they do really well. And Brookfield Business Partners, because I know that
Like
they're
you're doing
also
right now, explaining to a
yeah,
5-year-old.
no, but like Brookfield Business Partners, I know they're also venturing a little bit into tech and stuff. So there's some stuff in there that I'm not totally sure. So I've kind of stayed away from it. But I mean, I know that they've been getting good results too. But it's just I haven't dived as deep into it. And yeah, I think those. Oh, and they have Brookfield Reinsurance, which just they spun that off like last year, I think. They also expect to make tons of money from that. So yeah, it's great. And honestly, also for everyone who's interested in this company, the CEO Bruce Flatt, this is the guy who's made Brookfield. To me, this is like Warren Buffett but for Canada. And the thing is, he's still really young. He's
Yeah.
like I think like late 40s or early 50s. So he has another 20 years or 30 years to go, and he's definitely planning on staying there. So if they can continue the results that they've done for the last 20 years and do that for the next 20 years, then this company's going to make me a millionaire. I hope so. So yeah, it's a
Well,
really good one.
hopefully. Good. Yeah, hopefully for you. And that'd be great, right?
Yeah, it's
So
a good
yeah,
one.
definitely a lot of really great companies to look into there. Or I guess one company you might want to call it with Brookfield, but the umbrella of companies underneath and the subsidiaries, but so many different stocks and to research. So again, do your own research, due diligence. This is not financial advice, just
Yes,
two
it's
guys
all
talking.
entertainment.
You
Exactly.
did, you
Yeah.
did bring up yeah. You did bring
Yeah.
up 2 companies there that I do wanna talk about. One is Algonquin Power in energy, and one is Ryokan in REITs. So I'm going to just throw it back to you. Which way do you want to go, REITs or energy?
Let's start with Algonquin. Love the company, but very sad, obviously, by what happened. I thought a lot about it. I do think they have to cut the dividend. It's not their fault. They're overstretched. They managed to grow a lot by taking on all this debt to fund, their acquisitions and stuff. So that's great. But now that we have high interest rates that are probably going to be there for at least another year or so, I think they're going to cut the dividend in January. So that sucks because it's my fifth
dividend cut does seem to be the writing on the wall.
Exactly. It's my fifth biggest dividend payer, so it's up there for me. But I think for the long-term future of the company, they should do it. And for me, it's a long-term story. Like when I bought it, because I started position, I believe it was late 2020 that I started. For me, that was also like a 20-year compounder. Actually, for me, that one was really one of those that would give me good dividends and grow too. That was kind of what I was thinking. So yeah, good company, but obviously disappointing earnings result, and yeah, the interest expenses are a lot for their debt. But you
so
sorry, go ahead.
A good point that somebody, I think it was at Vote Willows, who responded about to one of my tweets about Algonquin Power. He's like, listen, just because the stock price is suddenly a lot lower doesn't mean their 20 plus hydroelectric dams are any less valuable, right? So they still own a lot of assets, and I think they're in a good position to rebound. But right now it is disappointing to watch a stock, especially one that you own, fall from $18 or $20 down to 10 or $9 or $10.
Yeah. No, you really raised a very good
All
point.
of a sudden, it feels like you've lost half your money.
Yeah. But
sorry, say again?
Yeah. No, I'm saying you raised a great point, which is their assets are still there and they're not going away, and they're still generating tons of money, right? So, yeah, actually, okay, I'm sorry, I have to bring it back to Brookfield, but the CEO, no, but listen, this is a great one. The CEO writes letters to shareholders every quarter. Those letters are so good. I remember when the pandemic started and everyone was panicking because that was my first crisis as a relatively new investor, because I started in 2019. So that was my first crisis, and I remember being like, "Oh my god, this is hard to watch. My portfolio fall 40%." But this guy's letters were so good, and he was really emphasizing how public markets and their valuations, it just goes all over the place, and it confuses a lot of investors, and that's when people make stupid decisions, to be honest. And he was making the case for Brookfield and their real asset strategy is that the value of their assets didn't go down 40% over the course of 1 week because of a pandemic, right? Their renewable stuff, their infrastructure, all of that was the same value because it's not even in the markets, right? So his approach anyway, or what he was suggesting to people, is to keep buying into real assets or into Brookfield because it's exposed obviously mainly to real assets. And with that, you don't have to worry too much about the fluctuating value all the time. You can just kind of put your money in there and then forget about it, kind of like an ETF in a way. And for me, that's a big part of the appeal with them as well, is that, like I said, it's like a Berkshire. It's like you just put your money there. If I could just put my money in there in January when I refill the TFSA every year and not invest in anything else for 20 years, and I'd probably be fine, So that's what I like about them. And so in that way, I feel the same about Algonquin and their assets. It's the same.
Yeah, no, I agree. Just like you said, just because 1 week of a pandemic and the prices drop by 40 or 50% doesn't mean you're going to go and sell a $1 million property 1 week for 500 grand. Like, just wait another week and it's going to be worth $1 million again, right?
Exactly.
Or it was never worth 500. It was always worth $1 million, right?
Exactly. Yeah.
So,
yeah.
And that's just the way the stock market fluctuates. I think correct me if I'm wrong, but Warren Buffett, that it says nobody knows which way the stock market's going to go on an hourly or daily or weekly or monthly basis, whether it's, up, down, left, right, sideways, like from hour to hour, day to day, week to week, month to month. No one knows. Like, day traders try to play as best they can and looking at different, cup and handle patterns and green candles and all that. I can't be bothered with all that technical analysis to try to make 20 or 50 or $100 on a day. I'm just like you know, buy and hold and let those dividends roll in every month, every quarter.
Exactly. Yeah. And yeah, Warren Buffett did say that.
And then next
Yeah.
And then next on the list, let's go back to Ryokan. As most people know, it is one of my favorites. I was lucky that I started investing in Ryokan after their dividend cut. So I got in at a good time when the price had, because obviously when companies cut their dividend, the price falls as well. So I saw that price fall and I saw, well, you know what? Yeah, they cut their dividend, but they're still paying a pretty good dividend. And I'm
Yep.
getting it at a pretty good discount now because the price fell. So I was just in a good position to buy in sort of, and again, I've said this so many times, I'm not trying to time the market, but I feel like I did get in at a pretty decent time. So,
Yes.
what are your thoughts on Ryokan? I did hear you mention it there a few minutes
Same.
ago.
Same with me. Honestly, I don't like timing the market too, but I did. And to me, this and Scotiabank, we talk about Scotiabank after, were my best trades of all time so far. I bought Ryokan at $14, like right at the start of the pandemic when it went crazy. I haven't added to it since. And so I got the dividend cut too afterwards, which brought my yield down from 9% to 6.8% or something, which I can't complain about, right? So I love Ryokan.
Right,
I think it was a real dislocation of value, you know, relative, like even if people said, oh, retail, like it killed the story on retail for sure. And now retail has more headwinds than before. Yes, that's true. But even then, it was still not like it went down way more than what it's intrinsically worth, right? And so I had no qualms
right.
about finally, you know, buying into it because I've been looking at Ryokan for a while before that, but I always thought it's a little expensive. But when that happened, I thought this is my time. I just have to buy those shares now. And then you know, hold on to them. And
Yeah,
so I told myself I'll hold it, and then when it hits $28, perhaps sell half of it, and put the other half somewhere else, or maybe just keep it. Like I don't know. But all I know is for now, and even
yeah.
at today's price, like around $20, I still think it's undervalued. I still think it's a good buy for anyone who wants some exposure to that, you know, real estate. So that was the first REIT I ever bought, and I'm very happy with that. And then I bought Smart Centers very recently, actually, around the $27 mark. I also like Smart Centers, but I prefer Ryokan. Yeah, I
Yeah, I
definitely
like
think
smart centers too. I don't own smart centers. It's been on my watch list for a long time. Someday I might buy it because I do like the REITs. I do like the monthly dividends.
me
I did
too.
hear you mention, one of the banks. Was it Bank Nova Scotia?
Yeah,
Let's get into talking
Scotiabank.
about Canadian banks.
Yeah. Yeah, yeah, man. Okay, well, I mean, I love the bank. Listen, the Canadian banks are one of the like the fifth wonder of the world, to be honest, because they've existed for 200 years. No, but really, they've existed for all this time. They've paid dividends uninterrupted, and they keep growing, and they make tons of money, and they have so much money they don't know what to do with it. You know what I mean? So Scotiabank, I will say, I have been disappointed recently. It's not a surprise. I mean, everyone who has Scotiabank's been kind of annoyed that you know National Bank and TD and all these others have been flying up there, and Scotiabank is kind of still there. You know, it's annoying, but it is still a high quality company with a good payout ratio. I mean, they pay 50% of their earnings. So they have lots of room. They're very profitable. I do believe still in Latin America. It's been a bit slower than we want, but it's gonna grow. You know what I mean? They're not gonna not grow
Yeah.
forever. So I think Scotiabank is a good long-term story. And the thing too that, you know, I also believe in reversion to the mean. At some point, Scotiabank and CIBC are going to start doing a little better, I think. And others like, you know, National Bank or TD may do a little worse. My time horizon is 30 years. For actually, no, it's forever because I don't plan on selling my banks ever. To be honest, that's my hope is to just keep them. So I think within my
And keep
lifetime,
adding to them at
Scotiabank.
your age, just keep dollar cost
Exactly,
averaging in, right?
exactly, yeah.
Look at what
So
Dividend John has done with, his banks. Like, you listened to
exactly,
that episode, and,
yes,
he's obviously killing it over just over 20 years, and you're looking at a 30, 40-year time horizon,
yes. That's
between
exactly what
25
I
and
aspire to do.
65. You've got lots of time to just pile up those
Exactly,
shares. Just
yeah. And
just
that's
pile them
what I'm
up.
doing. That's what I'm doing. So the thing I will say though is Scotiabank is a big weighting in my portfolio. It used to be my number one until recently with Brookfield because I've been so passionate about Brookfield. That's my number two. And the reason is actually because I said it was one of my best trades. I bought so much of it at the start of the pandemic too. So my average price is 54, which is really good. So even though it's been underperforming, I'm still, you know, way above. I have a great margin of safety, I think. So for that reason,
Right.
I'm very satisfied with that. And now, though, for for future banks, I'm actually looking more at Equitable Group. That's the one I've been adding the most like recently. I think for sure, actually, Equitable I put in the same category as Brookfield in terms of long-term compounders. But there are dividend raises too. They raised it 78% this year, which is unheard of. It's
Yeah, mind
insane.
blowing.
Yeah, it's crazy. So even if the starting yield isn't very much, it's one of those companies that I think in 5 years it's going to be an amazing year for people who just hold it. It's great. So yeah, I love all our banks. Honestly, like the big five. If you ask me which one should I pick, I think they're all good. I know there's this ETF. I forget what it's called, but there's one that has the banks, like all of them. I think that's great for most people.
Yeah. I'm sure
Yeah,
there's several ETFs that have the banks, right?
yeah, like all of those are good. I think we can't go wrong with Canadian banks. We're so lucky to have other countries next to us where we can keep growing. Like I said, the U.S. for TD and Latin America for Scotiabank and other. It's great. I won't bring up. I used to own this ETF which I sold at a profit. It's called HBA. It's Australian banks, and I was very excited about it because their banking system is also really good. And I just wanted it for diversification. However, when I started learning more about Australian banks, I realized they're having a harder time growing, primarily because Australia is, it's a bit of an isolated country, and they're having a harder time, expanding into other countries in the area. They can't really do that as much. Like it's hard to start a business in China, for example, right? Because they have all these extra rules and stuff. Plus, some countries, especially now, we don't, I'm kind of scared of doing things like that. So for Australian banks, it was more difficult, and as a result, their payout ratios are much higher. So they pay out 75% to 85% of their dividends. What I like about our banks in Canada is we only pay out 50%, but we have room to grow, like I said, in America or wherever. So I
Yeah.
think that's a huge advantage for us that we definitely shouldn't underestimate. And then when I look at European banks, I didn't tell you this, but I'm European. I came here when I was 16, and that's where my name newcomer comes from. It's actually not new investor; it's new to Canada. So I came when
Oh,
I was
okay.
16, and European banks. Europe is great for consumer goods and healthcare and stuff like that, but their financial sector is very shaky. The dividends are unreliable. The governments who tell them don't pay dividends anymore, they did that in the pandemic. It's horrible. So as an investor, it's really hard to invest in Europe for the financial sector. But here we're blessed to have great regulation like Europe, but great capitalism like America, basically. So it's the
Yeah.
best of both worlds.
Yeah, exactly. The set of the Passive Income Podcast brought to you by Bank of Nova Scotia. They hold them. They own half of this house. I own the other half.
Nice.
We're
Yeah.
working on paying them off, but they do hold the mortgage. So that is just happens to be the bank that I'm with. That my mortgage is with. I deal with the other banks as well, and I do own. I did start literally just because I was interviewing Dividend John. I bought a share of Bank of Nova Scotia, and I was like, John, the only reason I'm buying this is
Nice.
because this is the bank that has my mortgage, and I want to have at least one Canadian bank while I'm talking to you. But I do own one of
Yeah.
those ETFs you're talking about. It's called DFN, and that one does have, I think, all five Canadian banks. It might even
Oh,
have National as well,
nice.
and it also holds Bell, Telus, and Sun Life and
Oh,
Manulife.
okay.
So and
Oh,
it's a high yielder because it does the covered calls. So you'd have to go back and watch the episode with, I believe it was I Love to Travel, who really his whole strategy is the high yield ETFs that are basically using covered calls to pump up the yield from say a 5 or 6% yield up to a
yeah.
15, 16, 17%
Oh,
yield.
wow. That's a
Yeah,
lot.
yeah, if you haven't checked that one out, definitely check out the episode with at I Love to Travel.
I will. Yeah. Thank you for that.
Yeah.
Cool, cool. You brought up Bell, and I need to talk about telecom too, if you
Perfect.
don't mind.
That was gonna segue into
Great.
telecom, so let's go with
Perfect.
telecoms.
Listen, I love having these contrarian views because everyone hates me for this. Quebecor is the best telecom company in Canada. No one knows about it. So I'm French. I speak French. I read Quebec media. Like I'm French from France, not from Quebec. I read Quebec media, so I'm familiar with what's going on over there. I think because in our like Twitter community, like Anglophone, we don't know about Quebecor because I mean they do stuff in French, so people here we don't really know. But if you look at their results, over the last 10 years, they killed Bell, they killed TELUS, and I love Bell and TELUS too, by the way. Like, I own Bell as well, actually, and my fiance owns TELUS, so nothing wrong with the other telecoms. But if I look at a total return, Québécois, their payout ratio is like 40%, which is amazing. So they have room for growth. And the dividend yield right now, it's about 4%. So it's not as high as the others, but it's still not bad. It's respectable.
4% with room for growth. That's a good a good combination, right?
And the capital appreciation. So the last 5 years haven't been good, but the last 10 have been excellent. And I'm sure that over the next 10 years, they're going to grow. Now, right now, Québécois, I'm like, fingers crossed. I hope this deal comes through. But you're probably familiar with Shaw. They're trying to sell to Rogers, right? And they're in this whole lawsuit with the Competition Bureau and the government because it's anti-competitive, whatever. We'll see. So
there was just news on that today, actually.
Oh, there was. What did they say? I haven't seen.
Honestly, it was on the radio when I was driving home, and I was focusing on trying to get home to get this podcast going.
I'll check after this episode, and then we'll tweet about it tonight. But basically, the government said, you know what? The deal, they don't like it, but if Shaw agrees to sell Freedom Mobile to Québécois, then maybe the deal can go through. So of course, Québécois loves it, and the terms are favorable for them. They're buying it for 2.8 billion, which is steal for that price. So I'm very hopeful that if Québécois gets Freedom Mobile, they're going to bring real competition to everyone else, because so their telecom is called Videotron in Quebec. It's the cheapest and most profitable in Canada. They managed to bring prices down for everyone in Quebec, and they want to export that model to the other provinces. So it's great for competition, and they're really good at that game. Whereas, the others like Bell and TELUS, they've been enjoying near monopolies and been able to, extract so much money out of people. So I love Québécois. I think it's great. And another reason, by the way, why I think this company is really underrated and underappreciated is they don't just own telecommunications. They also have a lot of they have media, basically controlled in Quebec, but they also have like cultural things. Like they own record labels for really legacy Quebec music and culture. They own books, like publishing companies, things like that. So they really have a hold on that soul of the francophonie, in Quebec, right? So and because I know like the Quebec government, they keep saying, oh, French is disappearing and all this stuff. No, it's not. I mean, maybe a little bit, but it's not going to disappear. Those cultural assets are always going to be there. And for all the francophones over there, those assets are really important, and they're still going to be in high demand. So I'm really sure that Québécois is going to keep being huge in Quebec, and it's going to grow in Quebec. And if they get this Freedom Mobile, they're going to grow everyone else and give Bell and TELUS a run for their money, basically. So I love that company.
That would be great. That would be great if they did give Bell and TELUS a run and lowered the cell phone bills, because obviously as a consumer, we hate seeing our cell phone bill, knowing that in Canada we basically pay the highest cell phone bills in the world.
Exactly.
But on the other hand, as an investor, you go, oh, these companies are making money hand over fist, and they're going to pay me every quarter to basically not work for them. I'm just going to invest in whether it's TELUS, Bell, Rogers. Even I'm not a fan of Rogers, I'm not into Rogers, but and I don't own TELUS. I do own a very small position in Bell. But very interesting. You're the first guest to bring up Québécois.
I know. No one knows Quebec, but again, like I said, I think it's because it's in French, right? So no one in Anglophone Twitter really pays attention to, the one that really managed to shine through was Alimentation Couche-Tard. I think you've had people who talked about it, right? Did the guy talk about it? I think he did.
The dividend guy did talk about Couche-Tard, So actually, probably, I think I Love to Travel might have talked about it as well.
Oh, okay. Well, there you go. So I think that's the only Quebec company that really everyone in Canada knows. But other than that, people don't know some of the amazing stuff they have. It's crazy. Oh, and another one we have to talk about, because it's the top 5 in my portfolio, Canadian National Railway.
Oh,
this is my best stock. That and Brookfield are my 2 favorite stocks of all time, I think. Do you own CN or CP?
I don't own any transportation, whether it's rail or I know there's some trucking companies I've looked into. If you're patient, and the tree's there so you can't see it, but out that window, every 10, 15 minutes, there's a train going by. So
there you go. Yeah. CN, listen, I think it's one of the best.
There's one right there.
Oh, there you go. I think I mean, it might be the best company in Canada. The only problem I have with CN is it always trades at a really high valuation, but I mean, it's worth it. Like, I remember when I bought it at around $120. And at the time I was complaining. I was like, ah, this is such a high valuation. And now it's 172, so I mean, it's gone up pretty well, and it's held up so well, especially when the pandemic happened. So
Right.
it's great. I mean, this company is so profitable. It's a duopoly with Canadian Pacific Railway.
Yep.
The dividend grows. They hiked it 19% last year or start of this year. I don't remember. Tons of free cash flow. They keep buying back shares. They make so much money. They don't know what to do with it. So it's great. And the thing is, it has a wide moat because we need it. Like, if CN goes on strike, then we have 5 provinces that run out of fuel and stuff. You know what I mean? So we need CN to be there all the time. It's a great company. I don't have, like, I don't know. It's just the best. I think it's great.
No, I
Yeah.
agree. Both CN and Canadian Pacific are both very well needed companies in this country, right? Like, we rely on the railway. People don't realize. I work in purchasing and logistics in the food industry,
Oh, so
and yeah,
yeah,
obviously we do use the rail. We don't use the rail as much anymore, but I do know that there are, like, again, I live right near the tracks, and so I get stopped at a light down the road watching the train go by, and, like, there's lumber, there's, you know,
yep,
anything you can imagine on that train. Like you said, fuel that has to go the other way to the east, and yeah, it's so important to our our economy, but to our
life,
civilization as well, right?
exactly. Yep,
So yeah, I have no problem with anyone investing in the railways. Someday I might get there as well. It just hasn't been something that I've been focused on. Like, I think a lot
yeah.
of
The
people
yield
know,
is
I've sort of
low.
been focused on building up my REITs position and a few other things in a few different sectors. So transportation hasn't been really the sector I've you know
Yeah,
delved into
that's
too
fine.
deeply. Yeah.
Yeah, I mean, the dividend yield is really low too. So I understand people look at it like a 1.7%. It's kind of it's not that great, but the growth though over time of the dividend, I'm pretty sure they have a double-digit 10-year dividend growth rate. I feel it's like 12% or something, which is pretty good, you
Yeah,
know.
that's right.
So for me, CN is also one of those like long-term compounders that I want to hold for life, pretty much. That and Brookfield are really, and the S&P 500 ETF. Those are like my 3 core long-term stocks, not for income, but for capital gains.
Yeah.
Yeah,
And
yeah,
not
really good
necessarily.
company.
You have a great strategy, and again, it's because you're younger. You're not really dividend growth is great, but you're actually looking for company growth. What company is
Yeah,
going to grow the most in your lifetime, right? Whether and you might, even by the time you're 35, in the next 10 years, like, look where you're going to be. And
yes,
then 10 years after that, when you're 45, look where you're going to be. It's like these
yeah,
companies
can't
that are
wait.
going to grow, and some of them will grow their dividends as well, and you're just going to be like, yeah, you're in a great position. Just obviously keep going, keep at it. Um,
Thank you.
Great perspective on Quebecor, comparing that to Bell and Telus, because obviously, Bell and Telus have now become also media companies. They're not just,
Yep,
telephone companies. They're, obviously they have their mobility of cell phones and whatnot, but they also have, their, Bell satellite dishes have been around for 20 years or more now as well.
yep,
And,
yep.
Bell owns is it Sportsnet or TSN or both of them?
Yes,
I'm not even sure, but, like,
yeah, yeah,
Bell
yeah.
owns different media outlets as well, different television stations or companies, and so yeah, really great perspective there on the Quebecor, comparing that because yeah, Quebecor is definitely definitely one that's overlooked. I'm actually kind of surprised that at the dividend didn't bring up when I was talking to him a few episodes ago, but
Yeah, I mean,
another
okay.
sector.
Honestly, I don't want to. I don't want to like assume what how he thinks or what he thinks. And I love his content, by the way. So
Yeah,
it's not a diss or anything. But I will say, Québécois, it is polarizing because depending on where you sit on the Quebec independence issue, their CEO used to be like the guy who wants to leave Canada, like Pierre-Carl Pelado. So a
Oh
lot of
yeah, there's
people in
been lots of
Quebec,
those guys in Quebec. So
yeah. So a lot of people in Quebec really don't like Québécois or like stuff that they do because of that guy, which I think is a great reason not to invest in Quebec. But me personally, my opinion is I don't think Quebec's going to separate, and for that reason, I'm very happy to buy that company if I see that it performs well, even if I don't agree with the CEO, like his stance on that issue.
political perspective, yeah,
Yeah,
this isn't about politics. This is about show me the money.
yeah, exactly. And I mean, if I thought like Quebec next year is actually going to separate, then I wouldn't buy, because I mean the uncertainty related to that for me would make it a bad investment. But because
Exactly.
I'm pretty sure Quebec is not going to leave, I'm very happy to own that company, even if the CEO to me is a bit, I don't agree with him, but that's fine. So
Yeah, no,
yeah,
good, good. A couple more sectors I like to cover.
yeah, let's do it.
As you probably know, the food consumer staples. I work in the food industry, like I said.
Yeah,
I do purchasing and logistics in the food industry, so I'm very familiar with the food industry. But I also like the food industry and consumer staples because everybody has to eat every single day, right? So,
yes, I have great ones for that. Two
go for it.
amazing companies. The first one, I feel vindicated because everyone hated it for 3 years, and right now it's doing really well. Restaurant Brands International. I've held since 2019. You know it, right? So Tim
RBI,
Hortons,
Tim Hortons, Burger
Popeyes, Burger
King.
King, Firehouse Subs. I mean, oh, so firstly, I must say, like you grew up in Canada, right? You're Canadian since, okay, I came here as an immigrant. The first thing you do as an immigrant is you want to understand what Canada is like. So you go to Tim Hortons. Literally. And then you get addicted. I swear, immigrants love Tim Hortons more than Canadians do. So I love Tim Hortons. I have one right next to like 2 minute walk on this side and another one 2 minutes on this side. It's insane. So I go to Tim Hortons all the time and I love it. I honestly, people say, oh, the coffee's bad, whatever. I actually love Tim Hortons coffee. So I go there all the time. I love Popeyes too. I actually have one also 2 minutes that way. I love Burger King as well. You know what I mean? So there's really something about investing in companies that make a product that you actually enjoy and that you would have even if you weren't invested in it. It makes it
Another
even better.
train, another
Yeah,
train.
it makes it even better because when I go and I pay for my coffee, I'm like, yeah, I'm paying myself. So I love Restaurant Brands International, and the work that those people have done over the last 3 years to try and digitize their stuff. Like I remember Tim Hortons before their app. I mean, now I'm like, oh my God, it was so bad, but I didn't realize. But now the work that they've done with developing the app, and I think it's like 10 million Canadians or something have used the app at least once. It's a huge number like that. It's amazing. Right? So now you order ahead and it's so good. I mean, basically they're trying to do like Starbucks. And that's my second one that I have. Starbucks obviously is like, I mean, unbeatable, to be honest, in that category. I actually started that position this year when the stock went down quite a bit, like in the 70s or something. Yeah, people didn't like Starbucks because they had one bad earnings report because of China, the lockdowns, and Starbucks is big in China, so that hurt them. So I bought a bunch of Starbucks at that time in my RSP, and now of course it's up like 25% since then or something, and I'm very happy to hold on to it because it's a great company. They're so profitable. Their margins are huge. They charge so much, and people buy it. You know.
Yeah.
So I love Starbucks as an investor, not as much as a consumer, just because it's so expensive. As a consumer, I prefer Tim Hortons because that's more within my budget.
Yeah, yeah,
Yeah, but those
exactly. Yeah.
companies are awesome.
So yeah, RBI definitely has been on my watch list for a long time. I don't hold any. I do own a few other in that similar category. I have some pizza, actually quite a bit of a fair. I guess it's all perspective of what you think is a lot of shares of a company.
Yeah.
Of Pizza. I have another one
Okay. Yeah.
called SRV, and they own like the Jack Astors and a few of the other
Oh.
companies like that.
Yeah. Cool.
And they might have Kelsey's as well. I'd have to actually go
Okay.
back and look to see which restaurant chains they hold in their portfolio. But similar story on that SRV, where in the height of the pandemic, I'm like, either the smartest investor ever buying a restaurant in the middle of a pandemic where nobody's going out, or
Yeah.
or I'm either the dumbest or the smartest, one or the other. There's no in between, right?
Yeah. Yeah. And it did well at the end, right? I
Oh
don't
yeah,
know because I
I'm
don't follow
up
it.
quite a bit on
Oh,
it right
okay.
now, and
Nice.
it's paying a nice monthly dividend, and I have no plan on selling it because hey, let
Nice.
that dividend roll every single month, and
Yeah. Honestly, I'm super bullish on the restaurant industry. People need to go and eat and hang out with their friends and stuff, even with COVID. Like I told you, I had COVID last week. By the way, it was horrible. I don't know if you had it before. I'd never had it. It was my first time.
I've never had it.
It's the sickest I've been ever in my short life. I don't recommend it, but I'm good now, so it's fine. But yeah, no, it was tough. But now despite the COVID, people still want to go and hang out with their friends and have a good time outside or go on dates with their partner or whatever. So restaurants can't go wrong with that, and we all need to eat anyway. So as long as they're managed conservatively enough, then they're fine financially, right? So I love RBI. Like I don't know why no one talks about this company, because I never see it on Twitter ever. But I
well,
really
let's talk about it tonight. After this podcast, we'll get on Twitter and just tweet storm RBI.
Yeah, exactly. Yeah. But another thing too, I just want to quickly add is just the power of brands. Like Tim Hortons has been there for like what, 60 years or something, or more than that even. So those brands,
it was started in, I think, the mid to late 60s. So it's 60
so there
years.
you go. So those brands, like the longer they're there, the longer or the bigger their power is to stay there. You know what I mean? Because they get entrenched in society. So now it's more difficult for some random person to start a competitor to Tim Hortons. But Tim Hortons, it's like they're building their moats just by existing and by being part of this ecosystem of Canada and just being part of people's lives. And another thing too that I should
and not just Canada, they've expanded internationally now as well.
And that's the thing that I love too, is RBI builds one store every 8 hours. One store every 8 hours. There's a new one somewhere in the world, right? I saw that
Tim Hortons,
they just launched this year in India and in Pakistan. Those are huge markets. They're springing up everywhere. And the thing too, again, is I have to tell you guys, Canadians, a lot of Canadians are like, oh yeah, Tim Hortons is so bad. But guess what? For us, international people, we think Tim Hortons is amazing. Like for us, Tim Hortons is a premium experience. It's not like a bad coffee that you have because there's nothing else, which is what Canadians keep saying. But in China, Tim Hortons is a treat. It's like Starbucks, right? Same in India. And in Dubai, my fiance is from Dubai. She was telling me how over there, Tim Hortons is such a premium experience. They have all these special flavors that we don't have over here. It's so different. So their international growth, I think, is, as long as they continue, like they keep market share here, which they are, but they keep adding stores in other countries, they're just going to keep growing profits, and it's going to be great.
Yeah.
So it's a great long-term growth story as well, I think.
Oh yeah, and like you said, they've been literally growing. Like even just in Canada, obviously they grew a lot in those first 40 or 50 years, and so and again, like you said, I've lived in Canada my entire life. I've watched that growth my entire life, where the Tim Hortons just start popping up everywhere. It's like all of a sudden, there's 3 in a city, then 5 in a city, then, and depending on the size of the city that you're in, obviously, but all of a sudden you go from 1 in a small city to 3 or 4 or 5, and plus the one that's in the mall, plus the one that's just sort of with a gas station, plus the one that's over, just sort of as obviously there's a few of the standalone stores as well. But yeah,
exactly.
I can't agree more with RBI, Tim Hortons. Obviously they have the Burger King in that as well. And with, like you said, with the whole restaurant, like I said, I like owning the restaurants too. The Pizza.
Yeah, those are great
my
too.
SRV.
Yeah, I never owned them, but I've looked at Pizza. I always think it's a great brand. There's one 1 minute from where I live too. So, yeah.
It's like you could just start your entire portfolio just by the stores in a 5-minute walk around from your house.
Absolutely. Yeah, it's crazy, but it's great. Yeah.
Okay, now that we've talked about all the junk food, let's talk about healthcare.
Oh, yeah. I have just one.
Okay, what is it?
That's my worst performing stock ever. And that actually, I'm not going to talk just about the stock, but about the lesson learned. Teladoc. Did you know them? Teladoc Health? It's American.
No, but I think there's a similar one in Canada, like not a WebMD.
Yes, I don't remember the name, but yes, exactly. So virtual healthcare. So let me walk you through the bullish thesis that I had, at least when I bought it. Firstly, of course, the pandemic. Everyone was using it, so they grew very, very fast. Now they have 50 million users per year in America or something, which is a huge number. And I mean, I can't give you the numbers off the top of my head, but like the visits, it was exponential. So it's huge. And they are growing revenue, which is good. The issue and the big mistake that I made, even with the bullish thesis, the price I paid for it was not good. It was too much. And the thing is, I had a couple of really good picks at the start of the pandemic. And then I got this, I got overconfident. I was like, you know what? I'm actually a great investor. You know, I know better than the market. Let me just buy Teladoc at this ridiculous price. And of course, it's down like 75%. So I'm holding the bag. And the thing is, I actually do love the company. And I do think it's going to do great in the long term. So I haven't sold. But the lesson there was just, even if a company is great, you shouldn't buy it at any price, because otherwise you might spend years with like not having money. And the thing is, it doesn't pay a dividend too. So I literally have to wait.
So I just looked up the one. I know this is going to be inverted. You might not be able to see it, but it's called Cloud MD.
Yes, exactly. Yeah.
And it's at 20 cents. And I don't want to scroll down and show you because it looks like I bought in at $1.37.
Oh,
so
ouch.
Luckily, I didn't buy a lot of shares by the looks of it, so I'm not down by a whole lot of cash. But
yeah,
still, you know,
yeah, no,
you look at those things and they look. You're right; they looked great during the pandemic because everybody's doing this telehealth type thing, calling the doctor, you know, doing like this, like a Zoom type or type of call, like video calls with your doctor, and it looked like a great investment because that's what everybody was doing. Now we're getting towards the end of the pandemic. People are going back out to, you know, physical locations.
Yeah.
And you go from $1.37 a share down to 20 cents a share.
The thing is, I will say though, I still have a very bullish thesis for virtual health, and I'll bring my own experience into it too. So Teladoc, it's everything about health, including mental health. Now, I'm young.
Yep.
Every young person, everyone under 30 is depressed, basically, to be honest. We're all addicted to social media. No, seriously, like literally. I tried therapy for the first time.
I'm sorry that I laughed because my generation has a hard time even understanding that, but you're right, it is serious, right?
Yeah, so no, but listen to this. A year ago, I had lots of difficulties for personal reasons, but I was feeling pretty bad, and I was convinced, like someone convinced me, you have to try therapy, it's going to be great. And I was reluctant. I was like, no, this is stupid, it's not going to help, blah, blah. But I tried it, and it was amazing. And guess what? I never met my therapist. And guess what? Now that I've done this, I'm never going to go to a therapist office ever in the future. So everyone who's under 25 now, for the rest of their life, they're never going to go to a therapist office. Why would I take a sick day or a sick half day to go to someone in person when I can talk to them like this and they can help me out, right? So that's my bullish thesis for young people. And I was going to say, the reason I'm talking about mental health is Teladoc owns BetterHelp, which is the biggest mental health service in the world, actually.
And I've seen so many YouTube videos where the sponsor is BetterHelp, and it seems
owns that. So that market of depressed young people is going to grow, trust me, because social media makes everyone depressed. That's the first thing. Then for old people, we've seen how long-term care has been really bad in Canada, unfortunately, and it's really sad. That was one of the dark parts of our pandemic. You know, and my fiance used to work in one, so I know firsthand the stories. It's horrible. So a lot of people nowadays, people don't. I don't want to put my parents in something like that. You know what I mean? It's insane. But so a lot of old people are still going to need help. But what can they do? Well, if we have, let's say, so firstly, we have a never-ending supply of an old aging generation, right? People are living much longer than they used to, and we need to keep them alive, of course. So now, instead of putting them in these long-term care homes, what if they're not that sick that they can still live at home, but they can have a virtual assistant that helps them for everything, that reminds them to take their medicine, that tells them how, you know, what to eat or things like that, right? Yeah. We're still just at the start of this like virtual digital revolution. I look at Teladoc and I look at Apple when they introduced the iPhone. Do you remember a time before the iPhone or the iPod Touch? When,
of course, I had so many Blackberries back in the day, right?
Exactly. So to me, Teladoc and healthcare experience, we're in these times right now, there's so much room to grow for every part of demographics, from young people who are depressed to old people who need help, but who aren't.
And everywhere in between, people need healthcare, right?
Exactly. So for that reason, and again, Teladoc is the biggest in the industry, and you know they also have access to so much data, and with the data, they keep trying to make better matches to give people a better experience. So I am very, very bullish on the company. I just think I got it at the wrong price, and I'm paying the price for that, unfortunately. But it's fine. I still love the company, and I'm happy to hold it. And I think in 30 years, it will be a much different story than it is now. And I'm happy I can wait 30 years.
Well, yeah,
Yeah.
exactly, and that's, I'm sure back in the '80s when people first invested in Apple and thought, "Oh, what did I
Yeah.
just threw my money away," but you know what? If I hope some of them did hold on to those shares for 40 years because I'm sure they did okay after, like you said, after
Exactly.
the iPhone came out, Apple all of a sudden went, "Oh, this is quite the company all of a sudden," right?
Exactly. Yeah. So I like Teladoc. It's my only healthcare
And
stock. But yeah, I love healthcare sector in general, though. I just never got around to buying like Johnson and Johnson or something like that. It always seemed expensive to me, but I do like the company. Like,
yeah,
it's nothing wrong with getting it. Yeah.
cool. Cool, and then I was just mentioning Apple sort of last on the list, and we're gonna have to wrap it up quick, but technology,
Sure.
anything,
Yeah. Okay.
any
Let
thoughts
me
on
outline
technology?
another. Let me outline another contrarian. I'm going to be the contrarian in this episode. China. Everyone hates investing in China. It's dangerous. It's risky. I agree, and I know. But Alibaba is a really really good company, and I mean, I own it. So I made a mistake. I also bought it at a bit too high, and now I'm also holding the bag. But I think whether we like it or not, whether we like the politics or not, I don't like the politics, but the Chinese civilization, they're not going to just disappear and go away, right? The middle class is still
No.
rising. They have money to spend. They want entertainment. They want to order stuff, and they want really high quality services. Alibaba is made up of some really really capable executives. They know what they're doing. They have great products. They have a wide moat. They're everywhere, and they have other services in other countries in the region as well, like in Indonesia, Philippines, and places like that. So Alibaba, I think, is a great long-term story as well for people who are comfortable holding for 20 years or so. I
Yeah.
think it's going to produce very, very good returns. And right now, because the price is low, they keep increasing their buyback program. So that's one of the advantage. They're aggressively, like they announced, I think it was 25 billion for that they increased it by for this year. It's huge. So Alibaba's great. And other than that, I'm also really bullish on Facebook, Metaverse, Meta. Even though everyone hates Facebook right now because their Metaverse expenses are kind of a lot and people are getting scared. But again, like we didn't talk at all about like my life outside of Twitter, but I'm a musician and I use Facebook advertising all the time. It's extremely effective. It's much better than Google Ads. It's much better than anything else I can think of to run ads. So
Yeah.
there's me and about 10,000 other businesses that agree that Facebook ads are great and there to stay. So that part they have it locked in, and that's the margins are super high. Produces so much free cash flow, so they can afford to lose money on the metaverse for 20 years if they want to, and they'll still be a really high performing company. Even if we don't like the meta, I don't like the metaverse either. But even with that, they're still going to make tons of money. So I'm still bullish on Facebook, despite all the stuff, the drama that's been going on. You mentioned Apple. I think it's amazing. I don't have it because I think it's expensive, but it is,
Yeah.
the best company in the world, probably. Same for Microsoft. And I do own Google, which I'm also bullish on, but I prefer Facebook at current prices. Yeah.
Yeah, great. Great insight. I see we're already very close to an hour. It's just amazing how
Yeah,
quickly an hour goes by when we start talking
I
on these
know.
episodes.
Yeah.
And yeah, I just want to thank you so much to a newcomer. And oh, I'm sorry, I meant to do this way long ago in the podcast. You can find him on
Oh,
Twitter
all good.
at
Thank
Newcomer
you.
Invest. So go give him a follow over there. And yeah, thank you so much for being a guest on the Passive Income Podcast. If you're still watching this late in the episode, you have to subscribe. Those are the rules. I
Do
don't
it.
make them. I don't make the rules, but those are the rules. If you're still watching, click that subscribe button below.
Amazing.
Awesome. Thank you so much.
Thank you for having me. Like I said, it's an honor. I'm just a regular guy, but happy to be there, share